Let's go across and discuss the market trends and a lot of interesting insights which Jitendra Gohil, Head of Research at Credit Suisse Wealth, joining us now. Jitendra, good afternoon. Thank you very much for your time. We are having you on a very interesting day. Large part of the market actually and the economy was quite surprised because market was actually ignoring and not paying much heed to rising count of COVIDs across the many states, not only Maharashtra surely higher than many other. It was kind of ignoring it, but now it seemed to be catching scare and its impact on casualty on people as well as on the economy. What are your thoughts on this? Is this an opportunity in your view which is coming in for long-term investors?
Hi Ajay, and thank you for inviting me on your show. First of all, we think the second wave is different than first wave. In the first wave, we did not have vaccine. Fear was very high. This time around, I think people are more relaxed. We are also seeing vaccination drive is taking place. So I don't think the impact would be very severe of the second wave on earnings and overall sentiments. Obviously, in the near term, one profit booking was warranted given the way valuations have run up. So we think that this might be controlled. Let's say by end of this month, we may see cases might peak out. We also believe that this will pressurize the government to accelerate vaccination drive because we are not hearing anything in terms of vaccine shortages in India. We have enough of it. So I think we need to accelerate vaccination drive, and this will push the government to do that. And if we peak sometime in the end of April or so, we think that the earnings and valuation impact would be contained. So we think that this correction could be a buying opportunity from a around 6 to 9 months perspective.
Right. Jitendra, we are also having this discussion at a point when the earning season is about to start. You've been tracking the recovery in earnings, in the last 2-3 quarters. The stance has been of a recovery, and we were chatting about it offline also some time back. Do you see that momentum to continue? What is your early sense of how this quarter could be? Will it justify the valuations of the universe you look at? What are the sense?
Well, yes, you are right. So in the past 10 years, if you look at, we start with certain numbers and then we see disappointment at the end of the year. But this time around, we have been positive. So earlier, if you ask me, 3, 4, 5 years ago, every time we were actually below consensus expectations in terms of our earnings expectations for the market. But this time around, I'm pretty convinced that the macro recovery is going to be slightly better than what consensus is expecting. So I'm looking at FY23 in my valuations and numbers. I feel that that's the number that one should be looking at. And currently, Nifty earnings is expected to be somewhere around 820 for FY23. I feel that we might see some bit of surprise there. There are a few reasons why I believe market may see some kind of earnings upgrades as we move forward. First of all, the vaccination drive. So I think India has done a phenomenal job in terms of coming out with 2 vaccines as of now. We are also exporting vaccines, and our track record in vaccine administration over the past pandemics and the way we have dealt with other viruses, I think we will be able to vaccinate our population pretty rapidly over the next couple of months or so. Second, I feel that the rub-off impact of the US fiscal stimulus, which has been pretty strong, above market expectations, I would say. And still in US, there are talks of further stimulus. So I feel that the rub-off impact of US stimulus is yet to be felt. The third aspect of the market buoyancy or in terms of earnings, I feel the currency. We haven't seen such strength in currency for the past so many years. And this time around, despite pandemic, despite we are seeing these cases rising, I think UP has been pretty stable. And the government's reforms, to say also the kind of developments we are seeing on the geopolitics side, I think we are looking at a pretty decent couple of years from here onward. and hence I'm more optimistic on earnings outlook as of now compared to the valuations. So I feel while valuation may see some kind of correction because the yields have started moving up globally, dollar outlook was very weak earlier. Now it is not as weak as we earlier envisaged. So there could be a minor correction in terms of valuations, but that will be compensated by better than expected earnings recovery in FY22, FY23, in my view.
Jitendra, where do you stand on your thoughts on the rate cycle? The general view is that we have actually come down from high interest rate environment to moderate interest rate environment in India. But also there is also view that globally interest rates may have bottomed down the way yields rebound, indicating that rate hikes may lie ahead. Do you think the same kind of scenario could play out here in India as well, or you think rates may remain in a narrow range to what we are right now for some time before really rate hikes may come?
So Ajay, you're right. So see, the thing is, if you are expecting earnings recovery, if you're expecting macro recovery to be solid going ahead, and our house view is that the macro recovery will take place very sharply in the second half of this fiscal year, not just in India but globally as well, especially in US. So rates are going to go higher naturally, but how fast these rates rise, that we have to observe. So obviously the rates have moved from below 1% to around 1.7% in US over the past few months. But we feel that the rates will be capped at around 1.8% in the next 3 months. And from a 12 months perspective, we think US 10-year yield to go to around 2% levels. We are not saying the yields will spike very sharply to around 3 odd percent as some of the analysts are expecting. So we remain slightly bearish in terms of US yield outlook. That is number one. Coming to India, I think there are so many moving parts. One is currency, one is government's borrowing targets, the third is inflation. But net, what we feel is that the kind of reforms the government is announcing, the FPI appetite might go higher. And there are also some talks that our GSEC might get added in the global indices. If that happens, that will be a big boon for our 10-year yield and government securities yield. So I think there are a lot of moving parts, but net, we feel that government's tax collection is going to be slightly better this year. We have already seen some surprise in this March 21 numbers around almost exceeding our revised budget estimates by almost 20,000 crores. So the tax collection is going to surprise. That is going to be a positive sign. Second, the GST collection, for example, we have seen good buoyancy so far. We are also expecting that the tax compliance will go higher. So I feel that there are some surprises are on the way. However, we should not neglect inflation. So the commodity prices have started moving up sharply. We are also seeing some of the cement companies are talking about price hikes again. Steel companies, iron ore prices are a 10-year high. So I think inflation is going to be a key challenge. But so far, if you look at RBI's comments, in H1, they are expecting somewhere around 5% to 5.2% of inflation in the first half, which is reasonable. So we think that range, yields will remain in a range-bound fashion in India, and with slightly downward bias in case if our investment case plays out, that the recovery will be much faster than what market is anticipating. So I feel that around 5%, around in this range of 6% to 6.25, I think that is the range that we are looking at in the near term. And plus the currency is stable, so hope that we don't see major outflows on the FPI front in the debt market so
far. Jitendra, what is the complexion of your portfolio looking right now? If not stocks, you can share details of areas you've added weight on and areas you've trimmed your outlook on, just to get a handle of how you're positioned right now for your clients.
So Ajay, we have been slightly more optimistic in terms of recovery. So obviously we have higher exposure to the cyclical sector. We have been buyers of banks, private banks, but over the past couple of months, We have trimmed down our exposure to private banks. We are buying more of metals. We feel that the steel cycle is turning in India. And also the outlook for other commodities are also improving, such as aluminum. So we feel that some of the metal stocks, despite this recent rally, is attractive in terms of valuation, in terms of growth outlook. So we are adding into onto more of cyclicals in our portfolios. We have trimmed our exposure to banks. In the very near term, we are saying that one should look at IT sector. We have been underweight on IT, and we have recently added weights in IT over the past 6 to 7 weeks ago. So we are having a pretty mix of cyclicals and defensive, with a higher tilt towards cyclicals from a longer term perspective. The other aspect of our portfolio is that we expect the recovery to be broad based, right? So value versus growth, that argument is going on around the world. And we believe in India too, we might see a broad based recovery. And hence, we have been adding some of the mid caps which are into structural themes, such as businesses which are into hiring employees, the contract hiring, some of the contract manufacturers. I feel that there is a lot of headroom to do for these companies to do well over the next 3 to 5 year perspective. So we are adding cyclicals. We are overweight on mid caps. We are buying mid caps, and also we think that the recovery will be broad based. And we are underweight on some of the very highly valued consumption oriented companies. And I think that is a consensus view that FMCGs and consumption related sectors might underperform. But we are mix of these sectors that I have discussed with.
Let you go on that one. Thanks so much for joining us on the show today. That was Jitendra Gohil of Credit Suisse Wealth talking to us about how constructive they are on the markets, and they are actually recommending that this correction triggered by the second wave or the rebound in cases actually should be bought into. He doesn't expect big escalation in the numbers, and he expects that by month end, April end, things should get contained because of higher number of vaccinations and also overall much better handling by state governments. Let's take a short break. On that note, more news and analysis on the other side of the break. Don't go anywhere.